So I'm going to do a brief update here on Neo Performance Materials, symbol NEO on the TSX. Trades around $9.28, $388 million market cap. Pays a nice dividend, 4.25%. But what does Neo do? Neo, they are headquartered in Toronto, Ontario. They're an innovator and manufacturer of rare earth and rare metal-based functional materials, including magnetic powders, rare earth magnets, magnetic assemblies, specialty chemicals, metals, alloys that are critical to the performance of many everyday products and emerging technologies, which are essential inputs to high technology, high growth, and future facing industries. Neo operates globally through three segments. It's MagnaQuench, chemicals and oxides, and rare metals segments. Neo has a global platform that includes manufacturing facilities located in China, Germany, Canada, Estonia, Thailand, and the United Kingdom, as well as one dedicated research and development center in Singapore. Let's look at how the stock has performed this year. Like we said, in a weak market, it's actually up 16%. Most of those gains came after it reported Q4 numbers that beat street estimates. We see here over the last 5 years, the share prices are up, but remain in half from where they are in the $20 range that it reached in 2021 and 2022. So let's take a quick look at those numbers, the Q4 numbers and 2024 annual numbers released last week. Q4 2024 revenue was 134.9 million compared to around 128.7 million in the same period last year. So decent growth there. Year-over-year basis, 2024 revenue was 475 million. That's down from 571 million. Operating income for Q4 was 12.4 million compared to a loss in the same period last year of 5.5 million. So strong improvement there. Year-over-year basis, operating income was 35.3 million compared to 11.2 million. So good growth there as well. Adjusted EBITDA for Q4 2024 was 20.9 million compared to 3.1 million. Excellent growth there. On a year-over-year basis, adjusted EBITDA was 64.4 million, almost double the 37.2 million in 2023. Let's take a quick look at the balance sheet here. Neo has cash on hand of 85.5 million and 68.8 million in gross debt, 2.8 million in bank advances on its balance sheet. So it is in a net cash position. During the year, they invested 80.2 million in capital expenditures, primarily composed of the construction of its emissions control catalyst facility and for the new construction of its new permanent magnet manufacturing facility in Europe. Neo is under a strategic review. This was announced on June 14th, 2024, so it's been going on for some time. They announced that it's formed a special committee of independent directors to lead a comprehensive strategic review process to consider opportunities to maximize shareholder value. The process may or may not lead to a sale of the company, new direction, or a sale of parts of the business. It remains ongoing at this point, and we point out that the company, and we'll note this, the company, there has been no strategic, or can be no strategic assurance that the strategic review, process will result in any transaction or other alternative, nor any assurance as to the outcome or the timing. Let's look at valuations right now. This is based on the actual results that were announced last year. EV to EBITDA is about 3.5. Based on the estimates for 2025, the EV to EBITDA is 3.9. You can see it comes up there. We're expecting, and the market is expecting, somewhat lower, but not significantly lower EBITDA on an adjusted basis in 2025. So the conclusion here is it is an interesting company. We've looked at it for years. Valuations appear intriguing, but there's a lack of consistent growth and profitability. We can see here, this is the company's revenue and gross profit performance over the past 6 years. You see consistent inconsistency here in terms of growth and margin profile. Revenue is a high of 866 million in 2022, a low of 441 million in 2021, and today 684 million in 2024, with similar fluctuations as we can see in growth profit. Now, the annual and quarterly volatility leads to low multiples on the stock. And it's very difficult to forecast quarterly numbers with any degree of certainty. This is why the stock receives that low multiple and has led to likely the company's position in the market and its strategic review today. It can't get a significant market or multiple, off its EBITDA. Um, if we summarize the Q4 results here, adjusted EBITDA of 20.7 million exceeded the $11 million street consensus considerably. As you can see there, when you see a company exceed by that amount, it kind of tells you that it's difficult to forecast the earnings on this company or adjusted earnings. It's driven by higher gross margins on hafnium inventory and Magnequench process efficiency. The stronger Q4 results pushed full year adjusted EBITDA to 64.4 million. As we said, that was above the $52 to $55 million guidance range. However, adjusted EPS was a loss of 12 cents, and it missed the 6 cent profit consensus due to the higher finance costs and income tax expense, with elevated tax rates expected to continue given the geographic mix of profitability. The continued earnings unpredictability remains a negative. The stock trades at a discount to its peers, but the consensus is for both revenue and EBITDA to move slightly lower in 2025. It has potential, NEO does, as a takeover target, but we rarely buy just on that element alone. And with numbers expected to be slightly lower in 2025, we would just monitor the stock at present.
Yeah. I mean, this is a company we've followed for some time. And, the one thing is we knew that, CapEx, the company was investing, and, there was just heightened risk as, do you want to be investing while a company is increasing its CapEx and having potentially additional, costs? So that is one thing. I know as well, like their net cash position was much more significant, when we had previously been looking at it in 2022. Is that correct? I
Yeah,
believe
and
so.
they've gone out and raised capital as well, and
Yeah.
so and they're adding it. It was internally generated cash flow in the past, and there's going from a um, going to a fully vertically integrated model is the plan
Yeah.
here. That's going to take years. There's additional risk. I could see a strategic, a private equity firm taking this company private, them getting their ducks in a row in terms of getting the full vertically integrated business potentially going, and then relisting at some point. Like
Yeah.
that's what if I had to make a prediction, I could see that. Whether or not it gets bought out at a significant premium, that remains to be seen. They could just as well have a rare earths move against them in the next quarter, have a weaker quarter. The stock could come off and it could be taken over at a premium to where it is, but it could go down 30% and get a 20% premium. So you could be below it as today. I think a vertically integrated model here would smooth out profitability in the business. It's just not there right now. And I think not a good public vehicle when you have such fluctuations in quarterly and annual results. Potentially, if they vertically integrate over time, it smooths out those numbers. The company is in a sector that I think the market could take a shine to. It's just the volatility and profitability is there. And if you could smooth that out through vertical integration, I think that would be a better public vehicle so people could dig their teeth into, have more consistent earnings. I think that is likely the path here. Whether that happens or not remains to be seen. That's your risk right now if you're looking at it. It could happen. But that if I look at a playbook, am I going to look back at this company 10 years from now? I see it going private, coming public again. We'll see if that happens. We'll
In
make a
10 years, we'll
prediction
do a
on that
follow
now.
up. Yep.
Yes, we will.